We do think that the market, with as much as that it sold off, while we did think the market was overvalued coming into the year, we think the U.S. equity market is now actually trading at about a 20% discount to a composite of the fair values of the approximate, 700 companies that we cover that trade on U.S. exchanges. So I actually think that now is actually a pretty good time for investors to be layering into the markets.
So you're seeing value in the market at the moment?
We do see pretty good value for long-term investors in the marketplace. We do think that while it's volatile in the short term, for long-term investors, I think you'll be rewarded at the end of the day.
Of course, we know the recent selling has been caused by the aggressive action taken by the US Federal Reserve to tame inflation, and that was a point that was rammed home again by US Fed official James Bullard overnight.
Well, coming into 2022, there were really four main headwinds this year that the market was going to have to contend with. So first was just, the slowing rate of economic growth here in the U.S. Second was the expectation that the Fed was going to be tightening monetary policy. Inflation was already running hot and we expected it to run hotter. And our expectation also that interest rates were going to rise. And in fact, what we're seeing now is some new additional headwinds that have been pressuring the markets. So for example, the strong appreciation of the U.S. dollar, that's going to lower earnings for U.S. companies in the third and fourth quarter, those companies that have significant overseas businesses. Europe, it appears that they're going to be heading into a recession this winter. I think the question there right now is, how long and how deep is that recession going to be? And the economic outlook for China is especially murky. Now, having said all that, we do think that that is priced into the markets and that the markets probably have overcorrected to the downside here in the short term.
Well, BlackRock is advising its investors to shun most stocks because central banks simply aren't acknowledging the extent of the recession needed to quell inflation. That's at odds with what you're saying.
I think the market's going to want to see at least a couple of months of, downward, movement in inflation before they really get comfortable with that. But when I'm thinking about, the next year and thinking about, the economy here, while it may be sluggish here in the short term, we do expect that it'll start to reaccelerate in the second half of next year. The Federal Reserve, we estimate, will conclude its tightening policy by the end of this year. And while momentum may push interest rates, especially long-term interest rates, higher over the near term, we do think that we're closer to the top in interest rates than we were at the beginning of the year. And finally, we do expect inflation will moderate. In fact, next year, we believe inflation will come down to about 2.3% in the U.S.
In your view, then, how high will interest rates go in the U.S.?
Well, right now we're forecasting that the federal funds rate would drop down to 3.15% by the end of 2023, and that our 10-year U.S. Treasury forecast for the end of 2023 is 2.75%.
We talk a lot about rising interest rates, but the US Fed is also embarking on quantitative tightening, that is to unwind its nearly $9 trillion balance sheet. How's that affecting equities?
Well, specifically right now, they're actually doubling the pace of their quantitative tightening and increasing it, in September. And we have seen long-term Treasury rates in the U.S. back off, quite a bit thus far this month. I think here in September, we've seen the 10-year Treasury back off about 80 basis points, climbing to almost 4%, here in the U.S. And so as that risk-free rate, does increase, that does decrease the value or the present value of stocks. So we do think that's also been playing out here in the short term. But again, when we're thinking about our longer-term focus and thinking that at this point, the longer-term interest rates are probably getting close to where they should be peaking out based on our 2.75% forecast for next year, that's not something that really has me all that concerned for longer-term investors.
So with all of that in mind, you still see now as a buying opportunity?
We do. And in fact, this year, I think that thematic investing is probably going to be even more important than usual. And so we're really focused on a number of different themes that we think will play out over the next 12 to 18 months. So for example, we do see that consumer behavior in the US, is normalizing as the pandemic is receding. And so we're expecting to see a big shift in consumer spending, back into services and away from goods. Some of the other areas that we're looking at, will just be the long-term secular growth in renewable energy, especially in electric vehicles, which brings us to the point that we think that lithium is going to be undersupplied over the next decade, and we see a lot of value in the lithium miners. In the medtech space, we see a lot of opportunities there, especially for liquid biopsy companies, and also the cybersecurity industry. I think that's an industry that has, especially attractive industry dynamics. So all of those are different areas that we're focused on investors for today.
Dave Sekera, thank you.
Well, thank you. I appreciate it.